Welcome to the podcast from your RiskFootprint resilience team. We're your pathway to smarter hazard and climate preparedness, offering clear insights, actionable solutions, and expert support to help you safeguard your properties and build true resilience.
All right, today we're going to dive into a really critical question for pretty much any building owner or investor out there. How do you actually prove the return on investment for making a property resilient to natural hazards? It's not just about protection, it's about the bottom line. So let's get right into it.
So let me ask you this. Is your building an asset, or is it becoming a liability in our changing climate? It's a tough question for sure. But in a world where climate impacts are on the rise, it's one we absolutely can't afford to ignore. That line between a valuable asset and a huge financial liability, it's getting thinner all the time. The real question is, how do you make sure your property stays on the right side of it?
Look, the reality is, if you're a building owner, this is already on your radar. We all see the headlines, right? The rising costs from floods, storms, all kinds of other hazards. This isn't some problem for the future. It's a financial reality we're dealing with right now.
But here's the thing. Any big change, especially one that requires a lot of capital, it has to make financial sense. You can't just operate on a gut feeling about risk. The bottom line is simple. Before you spend a single dollar on a resilient retrofit, you're going to need cold, hard numbers that prove it's a solid investment.
And that brings us right to the heart of the dilemma. Deciding to spend capital on resilience is, well, it's complicated. Without clear data, it just feels like a shot in the dark. How on earth do you justify a major expense when the return is preventing a loss that might or might not even happen?
That is the million-dollar question, isn't it? To calculate a real ROI, you have to start by putting an actual dollar value on your risk. You've got to move from this vague idea of, yeah, my building's in a flood zone, to a precise financial figure you can work with. So how in the world do you do that?
Well, the answer starts with this key metric called the expected annual loss, or EAL for short. This is the concept that lets us take the abstract threat of a disaster and turn it into a concrete number that you can actually plug into a financial model.
So what exactly is EAL? It's the slice of your building's total value that you can expect to lose, on average, every single year, thanks to natural hazards. A better way to think about it? It's the annualized cost of doing nothing. It's the absolute starting point for any serious financial risk assessment.
And the cool thing is how logical this all is. EAL isn't just a guess. It's a data-driven equation that agencies like FEMA use all the time. It just combines three key things: the total value of buildings in an area, how likely a hazard is to happen each year, and the average damage we've seen from past events.
Let's make this totally real for a second. Imagine you own a building worth $50 million. Based on all the local data, the EAL rate is calculated to be about $1 for every $500 of value. You do the math, and your expected annual loss is $100,000 every single year. That's a huge recurring financial risk that's quietly chipping away at your asset's value, whether a disaster hits this year or not.
But, and this is a really important but, this initial EAL number, which is often based on county-wide data, is an amazing starting point. It gives you that first critical number. It is, however, a generalized estimate. The actual damage your building would take depends on its own unique features.
And that's exactly where we need to go next. To make a truly smart decision, you have to move past these broad estimates and get a risk profile that is tailored specifically to your property. This is where we go from general to super granular. The difference is pretty stark. On one side, you have that generalized EAL, a fantastic first look. But on the other side, you've got a much deeper analysis. This is where advanced modeling software like FEMA's HAZARDS program comes into play. It takes your building's actual blueprints, its site surveys, its elevation, and calculates its true value at risk.
So what does this granular approach really get you? Well, it gives you a vulnerability model that's specific to your building. It gives you direct guidance on the ROI of different retrofits you could do, and crucially, it aligns with industry standards, like those from ASTM, giving you a path to certification and the hard data you need to go and negotiate with your insurance carriers.
It's this level of detailed analysis that lets you shift from just knowing your risk to actually having an actionable plan to reduce it. It turns all that raw data into a clear, justifiable, and certifiable strategy.
And here's what that roadmap can look like. This whole process moves through these really clear stages. It kicks off with a broad risk screening of your whole portfolio. Then it drills way down to a deep assessment of a specific property, and then it calculates potential damage and loss. From there, it estimates what mitigation would cost, recommends specific fixes, and finally, it guides the implementation. It's the complete journey from data to action.
And what's so important here is that this isn't some proprietary black box thing. It's aligned with recognized industry benchmarks, like the ASTM International Standard for Property Resilience Assessments. That means the work is credible, it's consistent, and it can lead to a formal certification, which adds real, documented value to your property.
You know, Albert Slapp, the president of the risk assessment firm RiskFootprint, puts it perfectly. He says this is about moving beyond just data. The goal is to provide actionable intelligence. But what does that actually mean in the real world?
Well, actionable intelligence means you get clear answers. It means precise ROI models for specific retrofits. It means seeing the before and after numbers on potential damage. It means getting specific recommendations, understanding how long restoration would take, and having the hard data you need to negotiate better insurance terms.
Once you have this level of insight, the entire conversation just flips. Resilience stops being this defensive cost that you're constantly trying to justify, and it starts becoming a proactive financial strategy that actually gives you a competitive advantage.
And that's really the key takeaway here. By using data to quantify risk, from that general EAL all the way down to a building-specific analysis, planning for resilience is no longer a guessing game. It becomes what it always should have been, a strategic, smart financial decision. So, I'll leave you with this to think about. As risks continue to evolve, a documented, data-driven resilience plan is so much more than just protection. In 10 years, could it become one of your property's most valuable assets? Something to consider.
Thank you for joining us on this podcast. To learn more, visit riskfootprint.com.